Good afternoon and welcome to Nasdaq Trade Talks. I'm your host Jill Malandrino, global markets reporter at Nasdaq. We're coming to you from the market site in Times Square. Joining me on set, we have Mike Labella. He's the head of global equity strategy over at QS Investors, and we're going to look at some dividend plays for your portfolio in 2019. Mike, it's great to have you join us.
It's great to be here.
On Trade Talks, before we get into some of the dividend plays, let's talk about where we are now in the economic cycle. And with the FOMC minutes just coming out, kind of sounds like the Fed's in line with your thinking.
Yeah, absolutely. We've seen a remarkable turnaround from just a couple months ago. In December, we actually had the first negative year since the financial crisis, followed by one of the best market rallies we've seen in over 30 years. So clearly the market completely overreacted in terms of how bad things were at the end of last year, and we've been supported by the Fed up in January. The Fed essentially acquiesced to the market thinking that maybe things aren't as strong as they expected them to be. Growth is potentially slowing, and that's powered the market forward. The big question is, now that that's priced in, what's going to be the next catalyst in the market?
Well, you mentioned in your note earlier this week, timing the market is incredibly difficult, and I agree with you. And if anyone tells you otherwise, it sounds like they have a product to sell.
Exactly. I mean, you don't have a clearer example than December to January. The idea is the market went down almost 20% from peak to trough through September down through to December. What was followed was one of the best returns in 30 years in January. Now, if you go back over the last 20 years, if you just missed the best 10 days in the market, your return was almost cut in half. If you missed the best 20 days, you actually had a negative equity return. And those best days tend to follow the worst. So the idea here is now that we're entering the late cycle, there's going to be more volatility in the market. Things aren't just going to go up. They're going to move in both directions. You have to develop strategies for staying invested and not trying to time the ins and outs of this cycle.
And that shows the value of diversification as you're coming into these later stages of the cycle.
Exactly. And the problem is that diversification has certainly been hindered over the last couple of years, right? We're a couple weeks away from the March 2009 lows being a decade away now. Right, so this rally has been going on for almost 10 years. And if you look at the S&P 500 or the market as a whole, what you see is significant concentration in the index. There's a lot more cyclical, there's a lot more technology, that FANG exposure is much larger than it was 10 years ago. So to your point about when volatility starts, you want to be more diversified. And the problem is equity indices are actually pretty under-diversified right now because of the broad market rally.
All right, well, let's talk about some dividend plays and how they can play a key role in an environment such as this.
Sure. So one of those ways we think about enhancing diversification is looking for more defensively oriented stocks. So when we think about defense, what do we mean by defensive? These are companies that tend to have high earnings. They tend to pay dividends. So in other words, it's not just capital appreciation, but also income you're pulling from the portfolio. So if growth slows, that can pad the potential downside risk. But also their business models tend to be not as cyclical. So in other words, they're not as impacted to a decelerating growth environment. So the idea here is looking for these strong earnings companies, high dividend yield, lower volatility can really help investors stay in the equity market because we're not going into recession tomorrow, right? We probably still have several months or even years before we roll into it. But the idea is how do you keep equity exposure through these more stable companies that are not going to go down as much when we have that drawdown.
It goes back to your point too with staying invested, right? If you miss those top 10 up days, you could see how it impacts your portfolio. But when you talk about defensive companies that fit in this model, you're talking about consumer staples. I mean, you have to eat regardless of what the market does.
That's right. Consumer staple companies. There's stocks in utilities is one of the most basic defensive company. Look at last year. Again, the fourth quarter, the markets were down over 15% for the quarter. The utility sector was positive, up 1%, outperformed fixed income in that environment. So this is a really good opportunity to get that diversifying aspect. But you don't have to look at just consumer staples and utilities. The healthcare sector, consumer discretionary, even in the energy and material sector, there are companies that are robust, dividend paying, earnings based, low volatility across the sector spectrum to be diversified.
All right, stay invested, stay diversified, look at dividend plays. Thank you so much, Mike, for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.